Hi, I'm Aaron Rubin, your retirement plan advisor, and I'm here to talk to you about the third quarter of 2014. Got a little rough at the end, but overall, we're still alright, especially given the long term. I also want to talk about something called action bias and how it relates to active investing and why it can really hurt you in the long run. Let's get started.
The third quarter of 2014 has a lot of red arrows, which isn't very good news. Now, the only good performer in the stock part of the portfolio would have been the US large stocks, and those were up about 1.1%. The rest are all losers. Again, international lagged behind, and the global bond funds, again, stayed nice and steady just where they're supposed to. But why have international stocks struggled as much as they have? The answer lies in part with the US dollar, which has been exceptionally strong over the last couple of years. Now, what happens is that even though the returns abroad may be very good, when translated back to the US dollar, the stock prices end up being significantly lower. Here is a great example of what I mean. So, BNP Paribas is a bank in Paris. On the French stock exchange, the stock was up 6% in the last quarter. But when translated back to the US dollar, the stock lost nearly 3%. This is not helping international returns. Even though the last quarter wasn't particularly good, let's make sure that we're focusing on the right thing. Over the last 10 years, the markets have actually done pretty well. Now, 2008 wasn't very fun to live with, but at the end of the day, when all said and done, the stock market is still returning pretty decently. The US stock market, the S&P 500, up a little over 8%. Value stocks underperforming by a little bit, which is, goes against, a Nobel Prize that was won recently. The US small stocks up ever so slightly over the others. And the REIT fund doing very well despite having an absolutely horrible 2007-2008. International has lagged behind over 10 years, at least on the large value side, but the small stocks have kept up, and emerging market has done the best out of the asset categories. And of course, the bond funds have been slow and steady, again, not outpacing the stocks, but bringing some additional stability, which is what they're meant to do. Our hypothetical portfolios bear all of this out. In this last quarter, as we see in that first column, not great. Negative numbers. Wasn't great to be in the stock market. Over the 1 year, stocks outperformed. The 5-year, same thing, and even over the 10-year. Now, even though the stocks may be outperforming over long periods of time, that doesn't mean it's the right portfolio for everybody, right? The volatility plays a big part in it. There's no such thing as a free lunch, and if you want to take risk, perhaps you'll get rewarded, but perhaps not, and you have to be able to live through the bumps along the way. The more bonds you have in the portfolio, the smoother the ride will potentially be, but there's lesser expectation for return. Again, the important thing is that you're in the right portfolio for you. With the numbers out of the way, let's talk about my other favorite subject, behavioral finance. Today I'm going to discuss actively managed portfolios and action bias. Action bias occurs when we want to do something, anything, in the midst of a horrible calamity. And the best example is 2008. In 2008, as the market was crashing, everyone was trying to move to cash, trying to move their positions to a different stock or a different mutual fund, but there was really no safe place to hide. All they were really doing was increasing transaction costs and perhaps even locking in their losses. Another great example is an airplane. When an airplane hits turbulence, we get really nervous. Well, at least I do. But what would I never do? Take over the plane and try to fly it myself. Again, when we try to do something, anything, there can be disastrous results. Yes, the E-Trade baby. The E-Trade baby represents how media and commercialism can really affect how we invest and how we make bad decisions. The E-Trade Baby is a retired symbol now, but what it represents is something a lot more important. And you'll see those two numbers up there, 5% and 95%. 5% represents the amount in the market that is owned by retail investors. That's your average Joe on the street. 95% of the market is actually driven by large traders, professionals. So the fact that E-Trade's trying to tell you that you can outsmart the market is absolutely crazy. Even if there was an advantage, and I don't think there is an advantage for active trading, there's no way that individual investor gets their information fast enough to swim with the sharks. And take, for example, the breaking Twitter feed on AP, which actually turned out to be false. Again, the market, as a result, flash crashed. And if you were a retail investor, you could have lost a lot of money, by reading Twitter and reading your E-Trade feed, which would have been a really bad thing. And to extend the shark analogy, even the sharks, most of the time, aren't very good swimmers in this case. If we look at this graph, and it shows the percentage increase in the S&P 500, since 2009, a lot of people have been declaring doom and gloom along the way. And the fact of the matter is, maybe they've been right over a short period of time, but if you would listen to them over a long period of time, again, the investor does much more damage than good. And these so-called experts don't necessarily get it right most of the time, and perhaps hardly get it right ever. Because let's face it, a broken clock is right twice a day. So at some point, these guys are going to call a downturn. They'll be right. But if you pull your money out and listen to them, you might miss your upturn, which could have been better had you not done anything at all. So that's how wrong all the experts can be in the narrative. Let's look at actual data. Active fund managers who are on the top quarter typically don't stay there for very long. So in this graph, you'll see in 2010 there was the top quarter of the managers. There's that, which represent about 2,862 mutual funds. Now, over time, some are not in the top quarter in 2011, some were not in the top quarter in 2012, some not in 2013. Out of the 2,862 active managers who were in the top quarter of 2010, only 2 were able to maintain being in the top quarter for 5 successive years. That is an incredible number. What is the probability that you are going to choose that fund manager that can do that? The answer is about 0.07%. Quite frankly, I wouldn't take those odds. And for the privilege of something that very rarely works, the consumer is stuck with a pretty large bill. Active management costs about $102 billion annually. That's money that could be in the consumer's pocket. That's 2 times the level of U.S. government foreign aid. That's the whole GDP of Puerto Rico. Again, active management does not outperform the market typically and costs a lot of money. So it's well established that active management does not work. Study after study shows this. Yet, it is still the way that most assets are invested in the United States. Back in 1995, less than 5% of investments were in passive funds. It's gotten to a point where we're over 25%, which is a good start. The fact of the matter is, you want to be part of the minority in this case. And so, what we should really do is put action bias on its head. And that is by saying, when we see the market go down or do things that make us nervous, what we should say is, we are going to do something. We're going to do nothing. And by doing nothing, That's how we can best position ourselves for the long run.
While the third quarter of 2014 proved to be rough, and the beginning of the fourth quarter, heck, even rougher, it's important to make sure that you're in the right portfolio for you, that you're in the correct mix for the long term. Again, as long as you've done that, you'll be okay. Best of success in the rest of 2014, and look forward to seeing you in January of 2015.